Moody's has officially downgraded the U.S. credit rating, marking a major warning for the American economy. From rising interest rates to shaken global confidence, this decision could reshape financial stability worldwide. The downgrade hits directly at U.S. Treasury bonds. With increased perceived risk, the government must pay more to borrow. That means higher interest rates for mortgages, student loans, and credit cards as borrowing costs rise. Consumer spending and business investment could fall, potentially slowing the economy. What's worse, the U.S. already pays more in debt interest than it spends on defense. A downgraded rating means even higher borrowing costs. This deepens the federal deficit and squeezes budgets for infrastructure, healthcare, and education, raising concerns about the sustainability of America's fiscal path. Moody's also cited political dysfunction. From repeated debt ceiling standoffs to partisan gridlock, the U.S. has failed to implement credible long-term fiscal reforms. Global investors are beginning to see America as politically unstably a dangerous signal for a country whose assets underpin the global financial system. Treasuries and the dollar are considered global safe havens. A downgrade weakens that status. Volatility in global markets could rise as central banks, like those in China or Japan, rethink their holdings. Meanwhile, momentum may build behind alternative currencies like the yuan or euro, challenging the dollar's dominance in global trade. Rising U.S. yields may also trigger capital outflows from emerging markets, creating financial stress, currency devaluation, and investment slowdown, especially in economies already weakened by inflation. Geopolitically, the downgrade gives rivals like China and Russia an opening to question U.S. leadership. It could accelerate efforts to build a world less dependent on the U.S. financial system, signaling a shift in global power dynamics. There are three possible futures ahead. Policy stabilization: the U.S. restores fiscal balance and reduces debt. Confidence returns, rates stabilize, and global trust is renewed. Political gridlock continues without reform. More downgrades and persistent volatility may follow, damaging the U.S.'s economic leadership. Global investment pullback: a severe scenario where investors flee U.S. assets, weakening the dollar and risking a broader liquidity crisis. In the end, this downgrade isn't just symbolic, it's a warning. The world is watching how the U.S. handles its debt, politics, and reputation. What happens next could define the future of the global economy.